Hello everybody, this is Craig Moser. It is the 11th day of August 2020. Wanted to get with you and do a market update. Pretty interesting markets that we're seeing here, so bear with me a little bit as we move into some charts here. I know everybody loves my charts, but at the end of it, this is a lot of good information, and I hope you'll draw some information from this. So as we look at the various markets that we can invest our money in, it's interesting to see what is happening here. So let's look first at what we consider to be the vast majority, 80% of the stock market here in the United States. That is the Standard & Poor's 500 stock index. It's a big index. It's actually 505 stocks. I don't know why they don't call it the S&P 505 now, but that's what it is. And what I'm showing you here is a chart looking backwards for the past 2 years. So this is a 2-year chart, and you can see that back here was 8/13/2018, somewhere right around here, and the stock market is up quite a bit. Now I drew a line on these, trying to touch some of these different points in time, but the stock market is actually up over the past 2 years about 18%. So what does that tell us? Nothing. When you look at the volatility that has occurred from these markets, that's a different story altogether. So you can look, for example, right here, and you can see that we've had declines of about 18%, about 7 or 8%. This one was about 33%. And right now today, defying all of the mathematical gods out there, the S&P 500 is back up to just about where it was prior to this last major market decline. How come? More buyers than sellers. That's the best that I can tell you. When you look at a stock market, you have to understand there's more dynamics than just these guys are making a profit, because most of these companies are trading at very rich multiples. Now, a multiple, for those of you that really don't pay attention to this stuff, is saying, okay, how much am I paying for a potential of forward earnings? So let's look at Kraft Heinz in here. That's actually a stock that's doing pretty well. We're looking at Kraft Heinz. You can see that it has perked up from its bottom. And you can look over here on the left-hand side. Let me get my cursor back over here. And what you find is this company's really not earning a whole lot of money. As a matter of fact, it's burning some cash. It has a negative earnings per share, okay? So the price of this stock, $34.79, versus a loss of 15 cents a share for the past 12 months, I guess is how they're calculating it, is a negative PE ratio. So you go, gosh, these guys are selling a lot of mustard and ketchup. They should be in a good place. The cheese business is good, but yet they're not earning a lot of money. So that's the reason why this stock has been down and is just kind of working its way back up. When you look at Amazon, well, you can understand how Amazon makes money. And you look at that stock and you go, boom, that's great. So that should be in all of your tech indexes. That's in the NASDAQ 100 index. That's in the S&P 500 index. And you look at this and you go, marvelous, fabulous. They're earning $26 a share. Now, at a stock price of $3,148.16 worth of stock price, that is a 120, almost 121 multiple. So you're paying 121-ish times what its current earnings are to buy the stock. So you're basically saying that in 120 years, if they earn no more than they're earning today, you will catch that joke. But you can kind of see what we're seeing here. This is an expensive stock. It's always been an expensive stock from a price versus earnings standpoint. When you look at Apple, Apple has had different earnings PEs. It's been low, it's been high, but you can see you're paying only 34 times earnings for Apple. So is that better? Maybe. what I'm trying to tell you is the stock market as a whole is kind of expensive right now. So just understand that it's not just, hey, we're doing well, because we're kind of not. We're in a year that's a very difficult year. Depending on which TV channel you watch, you're seeing a whole lot of protests and riots in various large cities. You're seeing a presidential election year, which is going to be controversial. You're going to see this COVID-19 thing probably continue to be moderately prevalent here. And, you know, that just makes people depressed. That gets people on edge. And so I'm just telling you that the stock market does not accurately reflect what's happening in the economy right now today. And I'm just giving you a warning. When we make a double top, which depending on where you measure from, you know, if we're measuring from about right here, we've double topped here and here. So does that mean it's going to go up from there? I really don't know. What I do know is that stocks have sort of defied gravity at this point. Let's look at a few other indexes here so you can see that, you know, all is not great. So let's look at mid-cap stocks. So the mid-cap 400 index, those are not the great big mega cap Amazon, Facebook stocks. These are one niche down in size. What you see here is a market that for the past 2 years has not yet recovered. It's recovered a lot from down here where it was, down maybe 40% from 2 years ago. But we have yet to get back to even. If you're trying to be an investor, stay invested in an index or a stock in that index and say, how come it is that I'm not making any money? And the reason why is this particular block of stocks has yet to fully recover back to its, you know, where it was 2 years ago. It's close. When you look at small cap stocks, so that would be right here. You look at the S&P small cap index, their core index, and you can see these stocks have fared worse than any of the others so far in what I've shown you. So small companies are struggling more than large companies is what you should take away from this. So just understand all is not the same. You know, we're not looking at stocks, we're looking at different sectors of stocks. What if we look at overseas and say, how are those folks doing? And we look at an index that would cover, this is called Morgan Stanley Citigroup Index, Europe, Australia, and the Far East Index. This is, you could buy this from Vanguard, you could buy this from State Street, probably T. Rowe Price has the same index. There's a lot of them that do the same thing, but the core holdings here are identical. So what we used iShares, which is BlackRock, but it makes no difference. And you look back for 2 years, and although we've had spikes up, you know, we're yet to break the even point for 2 years. So as an investor, if you are staying put and buying and holding and not moving, what you're going to see here is that you're really not making any progress. You have ups, you have downs, you have ups, you have some significant downs. Right now, we're back up in a reasonable area for, you know, owning this particular index or any of the others. But just understand, there's a lot of weight, a lot of headwind, if you will, pushing against where we're at least for this year, for the short term. So optimism, you know, is a good thing. So let's look at emerging markets. Now, the largest single holding in this emerging markets index would obviously be the China stocks. And so from 2 years ago, we are up, you know, 1.752%, somewhere in this range right in here. But you can see that it's been, again, a difficult place to remain invested. To be 2 years and have an average return of, let's call it 1% a year, you know, doesn't really reflect the fact that it was down 30% as little as 3 or 4 months ago. Just trying to give you some perspective here. So stocks as a whole are fighting a fairly significant fight. Let's look at the bond markets because that's interesting. Let's go to Ag. This is the, used to be Lehman Brothers bond aggregate. And you can see a very interesting chart here. up 12.34%. A pretty good looking chart if you could ignore this piece right here, right? That was, again, where that market crashed. Don't you ask yourself this question: how come that thing took that big bounce? These are bonds. You know, in here are US Treasuries and IBM bonds and bonds from Apple. This is the entire bond market, at least the measure that we use to compare it to, the bond ag. And all of a sudden you see this big bump right here in the middle. Well, the Federal Reserve Bank came in and said, we're going to backstop all of these bonds. And that's why the recovery is where it is, because when you're looking at debt and saying to yourself, okay, the debt of America represented as a bond, you know, can we pay our bill is basically what we're asking right here. And so there was a little fear right here. But the government has stepped in and said, we will backstop bonds, you know, treasuries. We'll look at treasuries here. Let's find that one. So this is a US Treasury, 7 to 10 year. It's an index on those 7 to 10 year bonds, treasuries. And again, with only a few swoops in here, you see that the treasury market is very high versus 2 years ago. How come the bonds are so high and the stocks are kind of way edgier? Because this is a flight to safety. This is people saying, for the vast majority of my money, I'm afraid to take a risk being in stocks. Although stocks have recovered, this is where a lot of this money is in treasuries. How about gold? You know, as you look at a piece of shiny metal that earns nothing, that pays no dividend, it's up very high. Why so high? Well, once again, if you're looking at an economic picture and looking from 30,000 miles out and saying, how well is this economy doing? The US economy, anyway, is nowhere near as strong as it was this time a year ago. A year ago, we had a substantial, strong, powerful economic market where we were basically pushing our weight around pretty good. And with the advent of this COVID-19, it has really created some problems. So what I'm trying to get you to is, when you look at where the money actually is versus where the speculation is, be careful that you don't get too comfortable thinking stocks are a good, safe place to be, because a lot of it isn't. Here's another little tidbit. Let's see, and I'm going to quit for the day because I want to try to make these things short if I can. I want to look at this. I pulled this from, I think this is Market Watch or some Business Insider. Understanding that this S&P 500 index, wow, is not what you think it is. The S&P 500 top 10 largest companies represent 29 to 30% of the entire index. And this index represents about 80% of our entire stock market. So when you look at companies like Apple, Facebook, Amazon, Microsoft, Berkshire, Alphabet is what Google is, and look at these, Procter & Gamble, these guys have the largest weighting in that index. They don't equal weight the S&P 500. They give more weighting to the biggest companies, okay? So as you're looking through here, understand these 10 companies that represent almost 30% of the entire S&P 500's market weight need to do pretty well. If we have another big meltdown, as Market Insider is saying, you could see this move very quickly. That's why it moved very quickly before. When you look again at a stock like Apple and look at, you know, how it declined right here, it was pretty fast. And this was such a big market weight that it brought the S&P down with it, a lot more obviously, but it still brought it down. These are important companies because of the way that they are weighted in our various indexes. So I'm going to call it a day, but I would say that caution might be king right now. Rather than hoping that things will continue to go up, you might want to say, thank you very much, and take a little bit off the top of the table and be careful here. And with that, I'll bid you a good day, and I hope that you have a good month. Talk to you later.